Markets have been posting strong numbers this year, but there's no shortage of potential headwinds to consider. Investors are having to weigh everything from renewed inflation fears to uncertainty over the policies of President-elect Donald Trump. But my guest today says there are some positives in the market, and perhaps now the time is to take a good look at adding a little diversification to your portfolio. Anna Castro, Managing Director and Head of Retail Asset Allocation at TD Asset Management, joins us today. Anna, great to have you back on the program.
Thank you, Greg. Nice to be here.
All right, great to have you on the program when it's interesting times, and these are not boring times. They're definitely interesting times. A lot is happening every day, and just in the past couple of weeks. What's your take on what we're seeing in the markets right now?
Well, we see a sense of relief as well as increased anticipation and uncertainty. So let's talk about the positives. So first of all, let's take a step back. Economic growth, while weaker than prior year, is actually positive, whether it's in the US and Canada. And inflation is moderating, going the direction of the central banks. And this has allowed that globally, you almost have a synchronized easing with more central banks cutting rates than hiking. This has reduced the cost of debt. Banks are more willing to lend as well. And so this has been good for corporations. More and more different types of corporations are improving their earnings outlook, not just a large cap or a particular sector. Now it's even smaller companies. There's an expectation of improved earnings growth. And that means that in a way, in terms of price action in the market, you're having a broadening that's happening.
So we're at that broadening. We did enter this year with the expectation of rate cuts from central banks. As you said, they are delivering, bringing down the cost of borrowing. Of course, we had a U.S. election that took a lot of the oxygen for the entire year, waiting for that vote. We got the vote pretty clear. We got a Republican sweep. So we're talking about an agenda now when Trump re-enters the White House that's very pro-growth. How could that play out for the markets?
Well, first of all, as qualified, it's pro-U.S. growth.
Pro-U.S., okay.
Yes, it's domestic.
Oh, this is not going to benefit us?
So that's a big question. So definitely, like when you think about, he's very much pro-U.S. types of growth. So whether it's deregulation, reducing taxes, reducing the cost, the friction of doing business there, and that's positive for broader types of companies, not just the large cap, but as I mentioned, the small mid cap, financials, industrials, etc. However, there are implications to when you asked about broad growth. His favorite word are tariffs. And so how does that play out, and which countries has a big question mark on a broader theme on what growth and inflation will look like. Plus, this time, there's also a renewed focus on immigration.
Okay, so those two things. Let's talk about inflationary pressures. If it's pro-U.S. growth, but that means tariffs, there's been an argument that could be inflationary. Also, if you're talking about an immigration policy that sees people leaving the country and you reduce the workforce, that sounds inflationary too. How does this all start playing out in the U.S. economy? Is it too early to tell?
It's too early to tell. And so what you're seeing in the market moves depending on the day or the announcement. So the announcements right now, because people are anticipating what could happen, let's say Q1 2025, is bringing volatility into the market. So there's a lot of changing themes right there. But for now, economic growth in the U.S. is solid. Consumers are doing okay in general, and people are employed. And after the overhang of what the election outcome would be, or if it was contested or not, you have like a potential renewed interest in investing back into the economy. And so there's those positive themes happening, and that's also impacted not just the equity market, but the bond market.
Let's talk about the bond market. I just pulled up the U.S. 10-year bond yield on my screen. We're at 4.4%. Obviously, the bond market has been telling us a little bit something about what they think, where they think we may be headed.
Well, if you've noticed that it's 4.4% right now, it's actually a bit higher than when the Fed cut in September, which is interesting by itself. So what you're having right now is on the front end, you're also having some adjustments in how many cuts and how fast the Fed would actually cut interest rates. But more importantly, there's a recalibration of what longer-term growth expectations would be, inflation, and as well as the U.S. deficit, and that's impacting the longer-term bond yields for the U.S.
Right, so we've seen a lot of news, we've seen a lot of change, we're anticipating a lot of news going forward. These are not, as we said, boring times. We put all this together, we start talking about a portfolio, a strategy, and diversification.
Well, first of all, like when you have those bond volatility, at a certain point, let's say 4.4, you actually get to a level of 4.5 and worries about 5%. That can spread to other risk assets like assets equity. However, the moves within the top level of the US index may seem very calm, but underlying that, we're also seeing different drivers of returns of different sectors and types of companies. So in terms of diversification, the positive thing right now, while the central bank trajectory is being questioned, it's not only about the central banks driving the market. And so that has positive themes in terms of looking for diversification of sources, different companies, whether it's on the equity side and the fixed income side, but also alternative asset classes. So derivatives as a whole could also be a beneficial strategy when markets become more volatile. Options, depending on what the underlying is or the exposure could be used as a tool to generate extra income, also be a source of insurance, or a way to get exposure in a less capital-intensive manner. Another example of using derivatives will be participating on the price of commodities, of certain commodities, which has secular or cyclical themes, which is a different type of exposure than buying commodity-exposed equities. On the private side, on the private assets, they also provide interesting exposure for growing income, inflation protection, as well as stability. Examples of private assets would be real estate and infrastructure. So, and these are usually contracted, like long-term contracted agreements wherein you have beneficiaries of inflation, economic growth, and those contracts, and you have secular themes. An example would be that renewables, when you have a theme of deglobalization, data centers, when you think about now the focus on all the technological developments, and even ports, toll roads, airports, when you think about supply chains and that. So there are many different themes there, and I mentioned them easily, but there's a lot of complexity and nuance as well when you have to do your due diligence, the team resources, the type of relationships that you have to actually construct a portfolio to have that diversified source of return. And the real core of it is when you have changes in growth and inflation, in the near term, you have to really think about how do I interject sources of growth, of value, income, inflation protection, and stability in the portfolio to build that in the long term.